Well, hi there, everyone. Happy Tuesday, September 30th, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a lovely fall day here in Redmond, Washington. Not too hot, not too cold, not too rainy today, but a great day. Apologize for the late kickoff. We usually kick off right at 2 p.m. Eastern, 5 p.m. Pacific. I was doing some things here in the stock charts office with my friend Grayson Rose and others. And boy, one thing led to another, and here we are kicking off late. I apologize for that. I'll do my best to keep you updated through social media and through the community on YouTube when this happens before, but boy, it happened. However, the show will go on. We're going to talk about charts. We're going to talk about this fantastic afternoon rally for the major equity averages, putting the Dow, S&P, and the NASDAQ in the green for the day, as opposed to fairly deeply in the red. Right after lunchtime, we're going to talk about the heat map and focus on some particular areas showing strength. Sector at the top of the list today, healthcare, one of the sectors where I continue to find compelling charts when I do my regular scans for stocks making breakouts. We'll finish off looking at some charts together. I'll take some questions along the way. As a reminder, you are welcome to ask questions at any point if you're watching our live stream. We're live streaming on Facebook, LinkedIn, YouTube, and X. A pleasure to bring you this daily market recap and ask questions if you're live. We'll grab a question or two at the end of the episode. Any of the questions we don't get to, we will put in the mailbag. I'm actually traveling this week, so apologize for that as well. I'm actually not sorry. I'm very unapologetic about the fact that we are going to Michigan to visit my daughter, who's at boarding school. First time seeing her since we dropped her off at the end of August. So very, very excited to get the whole family back together. So I'm going to be kind of hit or miss through the remainder of this week. My goal is to do some market recap shows. I won't probably be able to do them live, but I'll record some videos and upload them to my YouTube channel. So keep your eyes peeled there. If you like my content, want to get some charts through the course of this week, should be back for Monday's episode, I would hope. We're actually flying back Monday morning. Having said that, let's get to the charts, shall we? The S&P, the major averages, having a significant late afternoon rally. Actually, the whole afternoon was pretty positive. From 1:30 p.m. on, the S&P kind of igniting a move to the upside. S&P finishing up 0.4%. NASDAQ Composite up about 0.33%. The Dow up about 0.2%. All of these indexes were down, sort of testing their lows for the day around 1:30 p.m. That last 2.5 hours really made a significant difference, with all of those indexes closing at their highs or right about their highs for the day. This puts the S&P to a new closing high, I believe. We'll look at the chart here in a minute. 6689. We're getting very, very close to the 6700 level. The 7,000 level is not too far above current levels as well. If you look above where we're at, mid caps and small caps even getting into the party here, both finishing in the green. The VIX moving slightly higher today. VIX still in a low volatility range around 16 and change. So we are still in a fairly low volatility environment. All my, again, having been through a lot of different market cycles over the years, and I would say one of the benefits of having hair this gray, although my hair started turning gray when I was 18, full disclosure, but one of the benefits of being, having invested or been in the markets for as long, 25 years for me this year, is that you've just seen different cycles. You've seen bull cycles, you've seen bear cycles, you've seen quiet markets, you've seen noisy markets. So nothing really surprises you because you have kind of a playbook back somewhere in your brain that you can dig out. You have a sense of, oh yeah, this reminds me of blah, which is why I often ask people on my podcast, right, does this remind you of a certain period in market history and why? And sometimes that leads to some really good discussions comparing what we're seeing now versus what we've seen before. And my word of caution for those of you that are newer on, and even those of you that have been investing way longer than I have, don't become complacent. Complacency is where the bull market kind of gets to you, and all of a sudden you feel like this thing's just going to keep going up forever. I don't have to worry about things like risk management or good habits and good routines. I will tell you, now is the time when you want to make sure you have a really good money management strategy, because at some point the VIX is going to spike and the uptrend is going to be over. And if you're complacent now, you're going to miss that really good opportunity to lock in those gains and get out before things get really ugly. So please keep that in mind. Hopefully, the fact that you're watching the show and you're following my work and listen to messages of more mindful investing, hopefully you've picked up on that message before today. But friendly PSA, public service announcement: do not become complacent in a bull market. One of my favorite quotes about that: never confuse brains with a bull market. All right, looking at the interest rate environment, kind of mixed here. You can see that the 10-year yield finished slightly higher to around 415. The long bond yield's around 473. The 5-year point about 1% lower, around 373. So we see the shorter end of the curve coming down, the longer end of the curve popping up a little bit of a steepening today, although still a fairly flat yield curve, depending on what comparison you're making. The dollar index basically flat from where we were yesterday going into the equity market close. So, 10-year interest rate, obviously 10-year yield, pretty important to watch. There are certain groups that are generally more interest rate sensitive, things like home builders, technology, usually tied to interest rates in some way, because the valuations of these great growth stocks are tied to interest rates, right? And that's part of the calculation. If you're thinking of the future value of cash flows, that's kind of what that's part of the calculation. So for now, rates drifting a little bit higher on the longer end. Looking at the commodity space, gold continuing to push onward and ever upward, as we like to say. The GLD closing above 355. That's up about 0.9% from yesterday. Silver down about 1/3%. The SLV, copper prices lower, crude oil prices lower. Generally, besides gold and nat gas, most of the commodity space lower today. Energy back to the bottom of the leaderboard. Spent most of last week at the top of the list, but this week back to feeling some pain. Looking at the cryptocurrency space, Bitcoin rallying pretty well along with equities. Bitcoin currently sitting around 114,300. Ether prices around 4170. Those are both down slightly, but have had a pretty good upswing here during the equity market session. All right, looking at the 11 S&P sectors, we can see healthcare at the top of the list, up 2.4%. Industrials up about 0.8%. Technology up about 0.6%. 7 of the 11 S&P sectors were in the green. That means 4 in the red. Energy, the worst performer, down 1.1%. Financials down 0.5%. Same with consumer discretionary. Financials down 0.5%. I mean, the XLF frustrating, I would say. There are charts that have looked really, really good, and I would say generally, right, like those big bank charts. Not to completely digress, but some of the big bank, like the KB, is probably a good way to show that. I mean, it's not a bad chart, right? It's a good chart, I would argue, right? If you had to choose one, is this a good or a bad look? It's good, right? We're making higher highs and higher lows. Look at this consistent pattern of making a new high, pulling back, consolidating, making a new high, pulling back, consolidating, breakout, pullback, consolidation. These other ones have kind of hit the 50-day moving average. That's where we kind of reset and have pushed back to the upside. Now the KBE is testing kind of not just a resistance level, but the resistance level. And that's what's different about this peak here is we're kind of stalling out at this big shooting star candle that you had from the end of November. That's been the all-time high for the Spider Bank ETF, ticker KBE. And we're kind of struggling to get through there. I think this chart above 62, clearing that resistance, is an absolutely fantastic chart, but that's a big if. Right now, we're in pullback mode. These previous pullbacks have stalled out at the 50-day moving average. The RSI has not gotten below 40. That's what I would be looking here. And as long as that happens, this could be setting up for that next big move higher. Now, some of the charts in this in that general bucket of banks looking very, very good, right? Goldman Sachs, had a shooting star candle last week, really hasn't continued higher, but still above a 21-day EMA. So a lot of the charts in this space look quite strong here, continuing to strengthen over the last week. Again, kind of, no longer pushing higher. That's what I'm saying. The XLF sort of like it's wait and see mode. It's like it's still not breaking out just quite yet in terms of the major ETFs there. Looking at breadth here very quickly, you can see kind of neutral more than anything, although the breadth on the S&P was fairly decent today. On the S&P 500, 61% of the S&P members were up compared to 39% down. If you look at something like the New York Composite Index, a little closer to a coin flip, but still advancers outpacing decliners slightly, 52 to 45% there. This has been my biggest issue with the current market environment, has been the lack of breadth support. That's often, and again, the reason why I often go back to that, because that's what happens at a lot of major tops, right? A market goes up on stronger breadth. That's a healthy bull market condition. Market goes higher on weaker breadth. That's actually a weaker condition, right? I mean, it just suggests that there's less momentum, less stocks kind of participating in the uptrend, and that's often what happens at the end of a bull market phase, is you get that breadth divergence. So the divergence is still there. I did grab a chart or two to show along those lines. Looking at the Magnificent Seven and friends, NVIDIA just continuing to go up. We talked about NVIDIA as it broke below its 50-day moving average in August. September, right back to the highs. Today, pushing above 185, clearing recent resistance. The market cap on NVIDIA is pretty huge right about now. Someone mentioned in the chat about $4.5 trillion. Is that true? I don't blame you. I mean, I don't doubt you, and you're absolutely right. 4.53 trillion says the quote line on stock charts. It's pretty remarkable. New all-time closing high today. Microsoft and Broadcom both up about 0.2%. Chart of Broadcom concerns me. Again, it's not a horrible chart. It's not a bad chart. It's just not a great chart right now. Great charts are NVIDIA breaking out, just blowing out to the upside. Broadcom, by the way, is still a $1.5 trillion market cap, still a pretty big stock, but pulling back, right? And so I would say charts like Broadcom look vulnerable to me, pulling back to the gap that we had from early September, pulling back to the 50-day moving average. I think we're kind of at a critical moment here, right? The bull case is it's another pullback to the 50-day moving average. It resolves higher, yet another upswing, higher highs, higher lows. That pattern continues. We break the 50-day, we break that gap range. We start to push down toward like 280. I think this looks like a much less ideal chart. And there's been very few up days on the chart of Broadcom since making that peak, that closing high around 370. Almost every day has been a down day, or at least that's kind of what the chart has felt like. So vulnerable there. Also a vulnerable name, Meta, kind of pulling back, testing the lower end of the range. I think I grabbed that chart, so I don't want to go too much into that just yet. Amazon down as well. By the way, I don't show a lot of the Dow industry groups, but I keep an eye on them. Semiconductors, aerospace names, defense names doing very well. But look at the healthcare groups at the top here. Pharmaceuticals up 4+%. I think we highlighted Johnny John on the chart on the show yesterday, J&J with the bull flag pattern. Biotechnology group up as well. So healthcare continuing to kind of pop up in scans for interesting charts, at least in my work. All right, let's get to the heat map and look at what's happened today at the sort of sector and group and stock level. As a reminder, I see some great questions and comments coming in on YouTube, on X, on LinkedIn, on Facebook. Thank you guys all, those of you tuning in live. Great to have you along the way as we review some charts and just talk about market conditions here. I like to keep the show fairly informal, look at some charts, just kind of share some of the things that come to mind for me after looking at charts during the day, and take a question or two. Again, any of the questions we don't get to, or if you're watching the show later on our YouTube channel, thanks so much for watching. We'll grab your question, pop it into the mailbag and hopefully have it queued up for our next mailbag episode. So what stands out to you when you're looking at this heat map? Again, this is looking at the S&P 500 members. Each box represents one member of the S&P. It's scaled by market cap. So the larger the box, the bigger the market cap. What stands out to you? I mean, for me, I'm immediately drawn, besides NVIDIA, which is a big green box in the upper left corner, I'm immediately drawn to the upper right corner of the heat map today, which is healthcare. And look at all the names that are up big time. Eli Lilly up 5%. I mentioned Johnson & Johnson up another 2%. This is after a couple big up days. AbbVie in the biotech group up over 3.5%. Danaher up 6.5%. Merck up almost 7%. TMO, which is Thermo Fisher Scientific, up 5% today. Not all of these are amazing charts. Like Amgen is not a particularly good chart. Danaher is kind of bouncing off of key support. But but a lot of these are starting to sort of show some improvement. And for these kind of charts that I think are still, have more to prove, I think determining sort of an entry point, right? What would you need to see on that chart to get really interested in it, right? What would be a constructive entry point? What would that look like? Set an alert on that level. That's the exercise I would be doing for some of these, charts like TMO and others. We highlighted Johnson & Johnson because of the bull flag pattern resolving to the upside last week. This week so far has been just nice follow through. A lot of these are a little earlier on, right? They're sort of below their 200-day moving average as opposed to above it. And my general way of approaching names like this, as you may guess, if you've watched my show for more than a hot minute, anything below the 200-day moving average, I am super happy waiting for it to break back above the 200-day. That for me is like the initial until and unless I see that, it's not the kind of chart I want to be playing around with. And that's why I would avoid something like Merck. Today, a nice up day, up almost 7%. We saw that in August with a really nice upswing right to the 200-day, and then it stalls out. So when something's been doing this for so long, I think let the chart let the chart make the argument that it now deserves some of your capital and deserves a place in your portfolio. Merck is not quite there. And I would say the same thing with charts like tech and others in the healthcare space that have been beaten down and are certainly, consolidating at the very least, and maybe starting to give you the feel like they're rotating higher. It's like, figure out that level. For me, the 200-day, like 58, that's kind of the level I'd be waiting for. And so I'm going to miss sort of this beginning move, but that's to avoid a Merck issue where you rally to the 200-day and then that's the next leg lower. So as more of a longer term play, that's what I would be looking for. As a swing, that's where you can tighten up your time frame and try to play some of these moves below the 200-day moving average. But it's more of like an investment approach for me, waiting for the 200-day on some of those names, kind of a general like base case, right? Until we see that, it's just not doing well enough that for me at least, it fits my general approach. So that's an exercise I think you can do with a lot of names within healthcare. I think, again, some of these charts are better than others. I think a lot of them have very clear levels like that you could probably pay attention to. On the other side of that, we're seeing like a reinitiation of the upswing in the aerospace defense group. Here's NOC, Northrop Grumman, up 2.5% today. Here's Raytheon, both of those making new all-time highs today. Here's Howmet Aerospace. Out of those three charts, is probably the most like classic, just kind of breakout. Name. Look at this, just move right above the previous resistance. We pulled back to 170. We're round tripping back to the highs. And then over the last week, we're finally pushing higher. And I think those kind of breakouts often lead to much further improvement. So I like the resumption of the uptrend we're seeing in the aerospace and defense names. I pointed out it's one of the top performing groups today. GD is another one in that bucket, making new highs today. And then in technology, we kind of have this familiar mixed bag of charts like Salesforce.com, which look like absolute garbage from a technical perspective. That's an industry term that we use to describe an endearing way of describing charts that just are completely underwhelming. This is a stock that is still in a primary downtrend. But I would say for every GoDaddy and every CRM, just in these primary downtrends, you have others that are really starting to show some nice breakouts and resume their uptrend. Apple is one that comes to mind, still holding up and holding up a lot better than some of the other Magnificent Seven names. Continue to be impressed by the hard drive names, Seagate, Western Digital, both making new all-time highs this week. And then we're back to seeing semiconductors look pretty awesome. Not all of them, right? Some of these better than others, but Empower kind of making a new high there. There's KLAC powering above $1,000 a share last week and continuing to go up. LRCX as well. So some of these strong charts just keep getting stronger. I think with things like semiconductors, with aerospace defense, you're seeing resumptions or renewed strength in the uptrends, pushing higher. With others like the healthcare names, for me, it's more of a, let's focus on some key levels, a trigger point where I would be willing to get in there. And then after all of that, I would say just really underwhelmed, continue to be underwhelmed by the lack of follow through in the financial space. Here's Blackstone pulling back. It's similar, had a nice bull flag pattern, which worked for about a week or two, and then has rotated lower. It's back down to around 170. COF, Capital One, came off of new all-time highs, kind of had this real issue of a divergence with every new high since the end of June, marked with weaker momentum. And now just today, we're closing below the 50-day moving average. Really haven't seen that since April. So that's the danger with some of the stocks like that have had really good runs. That's why we keep an eye on things like the 50-day moving average to see if there's that breakdown issue. All right, I think that's it for the heat map. Shall we continue on? Look at some charts together. If you're tuning in live, if you have questions, pop them in the chat here. We'll be ready to take a question or two at the end. I was in the Stock Charts TV studio earlier today shooting the top 10 charts to watch for October 2025 with Grayson Rose of stockcharts.com. We talked a little bit about market conditions and then went through some individual names. Chart of the S&P for me is just still a long and strong, up and to the right, bullish configuration, low volatility uptrend chart. I don't see anything really to be concerned about here. Any issues I've seen have been like overbought conditions 2 weeks ago, suggests a bit of a pullback. We got a bit of a pullback to the 21-day EMA. And as we talked about last Wednesday, we kind of tagged it almost exactly and then bounced higher to finish the week. Today, pushing higher, not quite a new closing high. That happened late September, but very, very close to that. But overall, we're above moving averages. We're making higher highs. I think what strikes me the most on the chart of the S&P right now is every pullback is making a higher low. And that's what an uptrend should look like. That's what a healthy uptrend looks like, right? In weird, unhealthy uptrends, we make a new high and then we undercut the previous low. And that's what tells you something might be up, right? This is no longer a healthy, constructive environment where people are just, religiously buying the higher lows and pushing the markets higher. That's what we're seeing here. We're seeing every low, not making it down to the previous low. That's the sign that willing buyers are coming in and buying dips on the S&P. The breadth, again, not great. It has ticked higher here in the last couple sessions. If you look at the bottom panel there, that's the percent of stocks above their 50-day moving average, currently around 59%. Again, what concerns me about the market going into Q4 is every new high since June has been marked by less stocks in the S&P getting back above their 50-day moving average. That suggests that there's weakness underneath the hood that's not being reflected because of strength in NVIDIA and Apple and all those other names that are kind of at or near new highs. It's making the indexes look better than the individual stocks might imply. Almost half the S&P are below their 50-day moving average right now, which tells you something's going on. And some names are certainly not working as well as the S&P and the NASDAQ. Something we'll continue to monitor. Again, there's one of two ways that this resolves. Either the market keeps going higher and the breadth improves. And that's why I think, starting to see higher highs on stronger breadth would be a really great sign as we get into earnings season, which is where there can be a lot of gaps and a lot of quick revaluations of equities. Keep an eye there. The other outcome would be the weakening breadth finally causes this market, the heaviness of those stocks not participating starts to weigh on the market, and the S&P starts to rotate lower. At this point, it's still an active divergence. I thought today, by the way, we look at some sector performance. This is something I do every week with my Market Misbehavior Premium members. I think we're seeing a bit of a rotation here. And again, as always, if you like what we're doing on the show, this is a piece of what I do. I try to keep some of my best insights and deep thoughts for my Market Misbehavior Premium members. This is a small group of mighty investors, like-minded investors trying to make more mindful decisions in their portfolio using technical analysis and behavioral finance tools. So check it out at marketmisbehavior.com/premium if you're so moved to do so. But this is one of the sets of charts that we look at every week. And I would say for the technology sector, the relative performance has been incredibly strong in September. It's actually close to making a new 12-month relative high. That's pretty encouraging. It actually did about a week ago. Compare that to communication services, which had been doing very, very well in August and for most of September. But from mid-September now to today, which is the last trading day in Q3, we're pulling back a little bit on the relative strength of communication services and consumer discretionary. Not enough for me to tell you this is a huge change and people are rotating out of these sectors en masse, but I would say it's definitely doing something different. We're seeing technology strengthen quite a bit, and we're seeing these other two growthy sectors start to rotate lower. So if communication services and consumer discretionary are rotating lower on a relative basis, what else is turning higher? Enter industrials into the conversation. Again, just up a little bit in the last couple of weeks on a relative basis. Still, I would say the primary downtrend here is down, but watching for a potential inflection point. The rest of the value sector is still, flat to down. And then utilities, which is actually hooked higher. So in the last couple of weeks, we've seen an improvement in industrials and utilities, a deterioration on the relative performance of communication services and consumer discretionary, something we'll continue to watch and tease out a little bit further with our premium members. All right, finish off looking at some individual stocks. NVIDIA back up to $4.5 trillion market cap, closing above $186 a share for the first time. This is making a new high, up about 2.5% today. The momentum is improving after this pullback where we briefly spent some time below the 50-day moving average. We're back above the RSI pushing above 60. That's all pretty encouraging. And I like the relative strength starting to push higher as well. NVIDIA is a good chart until proven otherwise, I would argue. Group within that Magnificent Seven and Friends group of stocks, not all look great. And I would say Meta, very much a vulnerable chart, very much close to looking not great in a big way. Meta has pulled back from retesting the previous high around 790 to now retesting the previous swing low around 725. The low from the end of August, beginning of September, around 720. We're kind of right there. The RSI is right at 40. We are dangerously close, having already broken below the 50-day moving average, having only one higher close through this entire week and a half period after retesting the highs. I mean, look at all these solid candles, which just speak to the distribution happening every trading day here, almost every trading day for the last 2 weeks. That speaks to the weakness we're seeing inside Meta. For now, if it holds support around 720, it's all is not lost. But if we break that, RSI breaks 40, I think this starts heading lower. 680, 675 would be my initial downside target based on the 200-day moving average and a Fibonacci retracements based on the April low to the August peak. Walmart is another one testing that resistance around 105. This is one of those charts where I feel like it's best to just set an alert and go do something else. If you're not already owning Walmart and just sort of following it, moment to moment, set an alert, right? Breaks above 105, that would be a new high. That would be a nice upside follow through in one of the big box retailers. It's a little more of a defensive play right now because this is a stock that's been underperforming. It's not been doing the great things that technology stocks have been doing. It's obviously a consumer name, but a breakout here would be a really encouraging sign. What concerns me about the chart of Walmart is this bearish divergence from August and September. Higher highs on weaker momentum, maybe a bit of a concern, but a chart to watch. All right, shall we take a question or two? We shall. Jay Ross, thanks for watching on YouTube. I love your quote. The only good thing I have done with an airline stock is not buy it. This reminds me of one of my favorite quotes about airlines. This is from wow. I am totally blanking, and sorry for that. Richard Branson, right? This is a Richard Branson quote talking about airlines. He said the easiest way to become a millionaire is be a billionaire and buy an airline. I love that quote. Such a great one. Airlines are a tough business, right? As he learned and shared in that fantastic quote. So you'd mentioned the only good thing I've done with an airline is not buy. I saw sort of a side question happening about all the airline things. Yeah, I mean, so it depends on what you're looking at. Delta Airline is one that came up over my on my weekend review of individual stocks because of breaking the 50-day. Right, we sort of have this classic pattern that's happened after the April low and after that initial run to the 200-day. We had a pullback to the 50-day, we made a new high, pull back to the 50-day, new high, pull back to the 50-day. And each one of these times we hold RSI 40. Now that pattern appears to be breaking a little bit as we push below the 50-day moving average. Again, not the end of the world, but certainly something that indicates to me a change of character. And that's after coming from a just a fantastic classic, what's called a shooting star candle. We're in an uptrend, the open and close near the lows of the day, big, long upper shadow, very little lower shadow, resolving to the downside. So I think, again, vulnerable, right? With charts like Delta, Meta, I think they're right at that place where if I did have a position, I'm really close to being stopped out because we're not making a higher low. We're starting to break the moving average support. But again, not all airline charts look the same. I would say Alaska Airlines is probably the least awesome chart that I can come up with. Alaska's the biggest carrier here in Seattle. It's over 50% of the traffic out of SeaTac, I believe, is Alaska Airlines. I think Delta is second. But Alaska breaking below the 200 and the 50-day earlier in September. Now it's just almost in a free fall, right? I mean, if you look at this chart, count how many higher closes we had just since that peak. And again, when we're looking at candlesticks, right? The open and close are marked by this real body here. So how many solid candles, meaning the close was below the open? I see one slight up day, and then I see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, right? So 12 out of 13, this stock's closed below the open. I mean, that just shows you the depth, the lack of optimism, the lack of demand. I mean, I don't see a lot of willing buyers coming in and looking to pick up some Alaska, or else this would start turning higher very, very quickly. So super challenge right there. Let's see. Josh, thanks for watching on YouTube. Can you look at United Healthcare? My spidey senses say a 2x in 4 years. I'm not going to judge your spidey senses, Josh, but I appreciate your question, and thanks for watching. Thanks for asking about it. So I would say United Healthcare, right? This is the chart of UNH reminds me of a lot of healthcare charts. The healthcare charts right now, if you look in 2025, look very different, right? So a lot of stocks, if you're used to looking at growth stocks like Nvidia or Palantir or any of those, you kind of have this general uptrend, and then they've kind of gotten squirrely here in the late summer into the early fall. Healthcare looks different. Energy looks different. These are sectors that have had a very different path in 2025. A lot of consumer staples, which are more in like primary downtrends. You can tell they don't look like the S&P, right? They look very different than our benchmarks. What's interesting, and when you have a sector that's struggling, when you have a set of charts that are doing poorly, again, I patiently wait for signs of improvement, what I call a change of character. So what constitutes a change of character? Well, we change from being below moving averages to being back above them. We go from the RSI being in a clear bearish range, consistently below 60, to being more in a bullish range, consistently above 40. We start to see higher lows and higher highs. We push above moving averages, and we hold the 21-day EMA. A lot of those things that I just said are true about the chart of United Healthcare. So I love, particularly on UNH, I think the break above 320, which kind of cleared that July peak, really completes that upside move. Right now, just in the last couple of weeks, we're in a bit of a what we probably call a pennant pattern, which is when you have a big run and they have this really tight triangle of lower highs and higher lows. I think breaking above 360. You have the 200-day moving average, which is looming large around $400 a share. But taking, the way that I would tend to think of charts like this, if you like the setup, but we're still below the 200-day, I like to think, all right, maybe I would take a partial position. Maybe I take a third of a position, and then I take another third if we can get above the 200-day, which means I'm not putting as much at risk now. I'm benefiting from the uptrend if I'm right, but I'm limiting my exposure if I'm wrong. So that's another way that, that I've sort of learned to play stocks below the 200-day that I would normally probably avoid. But I think the setup is good, and particularly since the end of July, this is a stock that turned very quickly, but now has continued a pattern of higher highs and higher lows. I wouldn't be surprised if we see more healthcare names like this continue to work and get above their 200-day. I think that would be the greatest outcome for charts like United Healthcare, charts like Merck and others. Like, they're really close to kind of showing that healthcare is kind of an interesting place to be, and that's despite arguably, I mean, a tough regulatory environment, or at least an uncertain regulatory environment. I mean, this is when Medicaid, Medicare, all kind of open question. I mean, healthcare. I mean, just the Obamacare plans, all a lot of question marks in terms of what those are going to look like related to the government shutdown. That's obviously a big sticking point. So even with that uncertain environment, when the charts start to improve, the charts start to improve, and I'm finding charts that work pretty well. I mean, Johnson and Johnson, perfect example in the pharmaceutical space. Even with all the challenges and the question marks, chart looks good, and I think as I always sign off with, it's always a good time to own good charts. With that in mind, hope you guys have a fantastic night. Good luck with all the government shutdown news. I'm looking at it. Doesn't look like there's anything resolved just yet. As always, keep tuning in to Chart This with Dave Keller. I will do my best to show you how the charts are anticipating potential issues, how they're processing news flow, and how the markets are reacting to big sudden news events. I think this is one of those times when you absolutely want to be following the charts closely. Hopefully we can help you improve your own ability to do it as well. For Market Misbehavior, I'm Dave Keller. Thanks everyone so much for tuning in. And remember, it's always a good day. What's my tagline? It's always a good time to own good charts. Let's call it a night. Have a good night, folks.